Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm covering part 2 of my precious metals analysis and forecast. This is silver. As I've mentioned in my previous video, silver is obviously in the precious metal class asset family, same as with gold, but it does have some key differences. One is that the industrial value for silver is higher than the industrial value to gold, whereas gold's industrial to monetary application is about 10 to 1. Or I'm sorry, 10% to 90%. So 90% is basically used for monetary uses in jewelry. 10% is used for some type of electronic industrial applications. Silver's is closer to 50-50. And because of this, silver functions more like a commodity than gold does. It is at times of the bull market where there's a rush for precious metals that silver's, what I call silver's monetary value, holds sway over the silver price. But then during normal market times, when the economy is functioning, silver functions closer to its industrial value. How I valued silver's industrial value is by using and comparing it to copper. I noticed that silver never trades below 50 times the copper price per ounce. And one thing I noticed with silver's when it comes to its monetary value is that it never trades below, or typically will not trade above 1/20th of gold's price. So in that case, you take the gold price divided by 20, that's your silver ceiling. However, something interesting happened between the 80s and the 2000s, and that is that gold to silver ratio started rising. It used to be that the average gold to silver ratio was about 40 or 50, meaning that on average, silver's price to gold was about 1/50th or 1/40th of gold, right? Well, that gold to silver ratio has increased, and now the average is about 70. So it's increased by about a 20 multiplier. And for the longest time, I couldn't figure it out. But after doing some research, I realized that what happened is that during the 1980s and 90s and until the mid-2000s, global governments were selling off their silver supply. And the reason why is because they had taken silver out of coinage. They didn't think it prudent to start minting their coins in silver anymore. And whereas before, global governments held as much as 400 million ounces of silver, that has since reduced. Their holdings have reduced to about 50 million ounces as of 2005 and has held steady per goldandsilver.com. Compensating for that means is that the maximum ceiling price for silver now is lower than what it otherwise would have been had that global government demand still have been there. And so the way I factored it is that by 2011, the ceiling price for silver now is about roughly 1/40th of gold's price, not 1/20th. So once you compensate for that and adjust it, you get this channel, and it works very, very well for silver. Silver tends to very rarely, except for in extreme bull market situations, not trade above its ceiling valuation price or its monetary value, and it won't trade below its industrial value, which acts as a floor price. So using copper and gold as basically the ceiling and the floor, or the floor and the ceiling for silver, tends to work very well. So now all we have to do is figure out what's going to happen to copper and gold in the future and compensate for that and establish a silver forecast. Well, copper is going to be easy. Copper is a function of any type of commodity. It's a function of the money supply and inflation, and the inflation rates are going up. The demand for commodities is going up. So copper is pretty much going to increase. The annual copper increase in price is about 18%, and though it's been dropping after it nearly doubled in 2021, there's no reason to think that it won't stop decreasing and resume back on its upward ascent. So more than likely, it's going to function along with other producer prices for commodity metals. It'll probably increase at about, say, 15% per year or 20%. In this case, I factored that commodity prices for copper are going to increase by about 20% per year, which is about half of the average inflation rate that is done ever since it came out of post-COVID. That over time is going to push up silver's price here, okay? And so here, you can see how copper's price functions is that it's establishing a floor price for silver. Right now it's saying silver won't ever fall below $14 an ounce. If we assume a 20% inflation rate for copper, then by the end of 2024, silver will never fall below $23 an ounce. So the current silver price today is going to be the floor price for silver 3 years from now, which means that silver more than likely will be pushed up throughout time. Now, if we assume a worst case scenario for the economy and an increase in the demand for precious metals, if we assume that in scenario 2 from my gold forecast on the previous video, that gold has a return much like it did in the 1970s, where it averages at 35% per year, then we can assume that silver's monetary force, that is, how close is it to that ceiling versus its floor price, is going to start increasing. And it's going to start approaching that ceiling over time as it catches up to the gold price. And if we assume that, it's telling you that if we do see 35% returns for gold, which is going to cause gold's price to increase enormously from, say, $1,900 an ounce to a whopping nearly $6,000 an ounce, that's about triple the price. Silver is going to increase even further. Instead of tripling, it's going to nearly quadruple, or it's going to more than quadruple, from $24 an ounce all the way to over $100 an ounce. Now that's assuming that scenario 2 takes place. But what happens if it says, okay, well, that's a real bullish market for silver. What happens if we just have scenario 1 where gold just gets about, say, 15% returns? Well, in my opinion, that would mean that more than likely that silver will have an upswing, a stronger upswing than gold, but it won't be as big of an upswing as it would have if gold started to go through a real bull market of 35% per year. Instead, what we will see is a slow increase in silver, but we will see stronger returns in silver than gold. Whereas if gold were to appreciate by 15% per year, much like it did during the 2000s, by the end of 2024, gold's price will hit at about, say, $3,100 an ounce. Well, what about silver? Well, if we assume that silver returns back to a monetary force of 40, which is much of where it was during 2020, so this is pretty conservative, then we're looking that silver's probably going to top off at about $44, $45 an ounce, or even go even higher, depending if there's a jump in the demand for metal. So all in all, the way I'm looking at this is that gold is going to be the dictate for how strong silver's upswing is. The stronger that we get in gold, the stronger that we get in silver, but the potential is definitely there that we're going to have a stronger return in silver than gold. Why? Because that tends to be how silver functions during precious metals bull markets. It tends to underperform or move up with the gold price during the early phases, but by the end phases, you'll notice that it will catch up to gold and start overtaking it in annual year-over-year returns. So trying to chart that out here and forecast is much more difficult. Why? Because we don't know when the crescendo is going to be. We don't know when the peak of gold is going to be reached. So assuming that we're just going to have year-over-year returns in gold, then we can price that into silver and assume that silver is going to move off of its floor price industrial value and move closer to its monetary value. The question is just how much. In the bullish scenario, the monetary industrial forces flip and it's 70-30. In the bearish scenario, silver does start increasing more to its monetary value, but it's still a 40-60 ratio. And so overall, that means that silver is probably going to be about $45 an ounce 3 years from now versus $100 an ounce 3 years from now. Now, does this mean that silver is destined to reach this? Well, no. If for some reason we do have a miraculous economic recovery, then we can see that silver's price will get depressed again, much like it did during the 1990s. And although it will probably trade as a premium to its industrial value, we just don't know by how much, but my guess is that it will probably drop to about $20 an ounce here or there until we see those copper prices push up again. But as we have more monetary inflation flow into the system, it's going to push up commodities. It's going to push up the price of copper. It's going to push up the price of steel and oil and everything else. And so with that, it will drag that silver price up. The difference between silver and gold is whereas gold is already trading at the floor and is ready to be dragged up, we may see silver stagnate for some time if we don't get either of these two scenarios to play out. But my guess is that we'll probably at least get the gold scenario to play out at about 15% per year annual returns, given the current economic environment with higher inflation rates and negative interest rates. Now, that can always change, but I really will be surprised, if we don't see the 1970s market emerge if inflation does spiral out of control. If inflation gets up to, say, over 10%, then my guess is that we'll probably see gold appreciated about 35% per year on average. And if so, then we're going to see real returns for silver, and it can be a very lucrative investment to make, even against the superior precious metal of gold. Now, the consequence to this is that silver obviously trades at a higher premium to gold. You have to pay more for each ounce of silver over its spot price than you would for gold as a percentage. But the application of that is that the potential for returns in the bull market is greater than what you would see in the gold price, and this relationship definitely bears out in the previous two bull markets. So, right now, it definitely looks like that we're looking at silver to potentially double from its current price right now, if not quadruple, whereas with gold, it's looking like it can increase by 50% or triple its price, depending on how the performance plays out and whether we actually get a repeat of the 1970s or if we get a repeat more of the 2000s scenario. Guys, thank you for watching this video. If you have any questions about this, let me know. If you think I've missed something, I'd love to hear from you and hear your thoughts on it. Or if you think I'm right on the dot, let me know about that. If you like the content that I provide, make sure you just click that like button to show me some support. If you haven't subscribed to my channel, please make sure that you do so. Click that notification bell, and so that way you'll always be privy to the updates that I upload to YouTube. As soon as I do, that will notify you, and so that way you can view my content before anybody else gets a chance to. Once again, guys, I thank you for watching this video, and I'll talk to you later.